Welcome to Oregon Cash Flow Pro. My name is James Barber. As always, I'm here to help you maximize your cash flow. I appreciate you guys joining me. Today, we're just going to go through and look at the comments that people have left recently. Nicole is asking, how do you stop funding IUL after age 65? Good question. So an IUL is a flexible premium type of policy. You're not required to make any payments in any given year outside of whatever the minimum requirement might be at the beginning of the policy. And later on in the policy, as long as there's enough money to cover the expenses each year, then it's flexible. You don't have to put money in there. The insurance company just looks at the cash value in your account. Okay. As long as there's enough cash value in your account, when the insurance company needs to reach in and grab out the expenses, they don't care if you're putting new money into that policy or if it's just growing based on the value that's in the policy and the index growth, right? Or maybe you funded it a large amount at the very beginning and you never filled it back up, but there's still plenty of cash in there for them to keep pulling out those expenses year after year after year. With a proper design policy, we're going to have very low expenses. And it's possible that you fund it for 10 years, you've got enough cash in there to fund it for another 50 years without putting any new money into it. So you can definitely stop funding after age 65 as long as you do the projection, do an in-force illustration, and make sure that based on whatever your plan is, maybe you're pulling money out, maybe you're not, but make sure that there's enough cash in there to cover the expenses. The thing about after 65 is those expenses are going to creep up a little bit faster and a little bit faster because the only expense that should be in your policy at that point is likely the cost of insurance. And that's just going to go up every year you get older because the cost of that insurance is based on the likelihood that you're going to die that year. So every year you get older, it's a little bit more likely that that's going to happen. And then finally, how do you turn off the expenses after age 65? There you go. That's a good question. So with an IUL, there is a way to actually turn off the expenses after age 75 with most IUL. And there is one IUL at least that you can do it after age 65. And that's with utilizing the overloan protection rider. Utilizing the overloan protection rider, you're just going to borrow out as much cash value as they will let you, generally like 95 to 98%. And then you trigger the overloan protection rider and walk away with your money and you don't pay attention to the policy after that. The insurance company is going to maintain a small death benefit until you pass away so the policy doesn't lapse. That's what the overloan protection rider is designed to do. So whether you accidentally borrow too much or you just purposefully need to take all the money out and go use it and you don't want to have to worry about your policy, it effectively shuts off the policy. Now, you're not going to have any ability to access any more cash in that policy. You've borrowed it all out, essentially. They will let you pay the loan back or some of the loans back if you want to, but there's not really a reason why you would want to do that because you don't have access to borrow it out again. Okay? So essentially, you're only going to use that overloan protection rider if you plan on walking away from the policy. Now, I don't expect that we would need to use that unless it's an emergency, unless you've accidentally borrowed too much money. At any time, you can always choose to withdraw the money, and that would also turn off the expenses. If you just take all your money out and walk away, you're essentially closing the policy. Now, you're going to get a tax bill on the gains. You pay income tax rates on gains in that policy. If we don't do that, if we just borrow against the policy to access the cash values, there's no tax bills. And it grows tax deferred. So that's why we like to use these things. And it's possible that you can utilize the wash loans rather than doing actual withdrawals and safely meet the needs of what you would otherwise withdraw for without having to worry about that tax bill. So those are things that we can talk about. If you ever get to that point, just know, get with your agent. You could talk about these kind of things and figure out what's going to be the best approach for you. So hopefully that helped answer your question there, Nicole.
I hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.